Yeah, so the slight difference for a dividend growth strategy for this is you are looking at stocks where you are focusing a lot more on the dividend, like a smaller dividend yield. So that means you're looking at both the capital and the dividends. So a lot of times when, as Singapore investors, like myself, when we look into dividend stocks, typically we like to be looking at stocks which have a much higher yield. So we ignore the capital gains or the share price performance of the stock. And that could actually be quite dangerous because if you only focus on that, you might not be able to get the benefits from, let's say, the share price performance. That's one. And number two, focusing just on the dividend yield itself might lead to some big mistakes because you might actually step into some of the traps of dividend investing because they might be paying out unsustainable dividends, for example. Whereas for a dividend growth investing strategy is you are looking at stocks or companies where they have a slightly lower payout, meaning that the dividend yield is much lower. Typically, you might be looking at 2-3%, which might traditionally put a lot of traditional dividend investors off because you might not get that yield. But over time, what you're expecting for this portfolio to do is to compound these dividends because you are riding on the view that the business, the underlying businesses which you are investing in, is able to actually compound its profits, its earnings over time. And that allows it to pay growing dividends over the long term. So if you see over the last 50, 60 years, even though the stock market has performed really well, but what was driving most of the performance, at least for the US market, is actually the dividend growers and the dividend payers themselves.